Hi traders, Chris Weston here, Head of Research at Pepperstone. We're going to have a real deep dive into the gold market. Gold's one of our most traded products here at Pepperstone, so I think it's wise every now and again, and we're trying to do this on a weekly basis, to have a really deep explore into, a 360 sort of explore into the gold market, looking at positioning, trading themes that you need to trade. Even if you're trading off daily charts, 4 hours, or you're going into something much more short term, like 2 to 5 minute scalps, we can get a really good oversight of the dynamics that are taking place in the gold market. Things like volatility, positioning, all those factors that really come into the trading consideration. So let's have a deep dive into what's been going on. I think the first factor which we're going to talk on is the actual currency performance, because whilst we can trade gold in US dollar terms, XAU, USD. We can also trade it in alternative currencies such as the pound, the Swiss franc, the Japanese yen, the Aussie dollar, and the euro as well. Now, the idea behind this is you can get double bubble, or more bang for your buck, max out the P&L. And really what you're doing, if you're looking to take a long position, is you want to do it in the weakest currency, and if you want to take short positions, then you want to do it in the strongest currency, and you'll max out that position. So what we're doing is just trying to understand it. First of all, is what has been the strongest currency over the last 5 days. Now, of course, that doesn't project that means we're going to get stronger currency over the next 5 days, but it gives us a sense of what's really worked in the gold market. And as you can see, the Japanese yen and the British pound of the currencies we offer gold in has worked incredibly well. The Japanese yen has gained nearly 91 basis points relative to the dollar over the last 5 days. So being short gold in Japanese yen terms probably would have limited the damage. Obviously, the gold price has been pushing up a little bit higher over the last 5 days. But if you were short and you were short in Japanese yen, you would have limited the damage there. On the downside, though, you can see euro of the currencies we offer gold in alternative currencies has been the weakest, down 0.5% relative to the US dollar. So being long gold in euro terms has been quite an advantageous trade. That's been where you've been getting the best buck on a percentage basis. Let's have a look at some of the trading dynamics in gold. I've just looked at this in US dollar terms. We'd looked at the high-low situation relative to the prior day's close to give you a range. And you can see that we did get a bit of a spike up in mid-June, but generally things have settled down. I've got a 5-day moving average here, but you can see the ranges that we're seeing in gold on a daily basis are starting to push a little bit lower. As traders, we do like movement. We like range expansion, and regardless if you're trading on daily charts or 5-minute charts or whatever it is, the idea about volatility is consistent regardless if you're trading your own structure or whether you're trading an expert advisor. It's really important. If we have a look at the options market, and I want to look at 1 week implied volatility, this is a really key component that goes into the pricing of gold options and options more broadly. And what we can see, that's currently trading at 12.85%. Now, that is an annualized number. It's a 1 standard deviation number. But effectively what it does is it tells you the expected movement. And we try and put it in context. You can see, but back in March 2020, the implied volatility was sky high. People were expecting massive movement on a daily basis, or a weekly basis in this case, in the gold price. It's settled down. And it's not so high at the moment. Now, I certainly would like to see a little bit more expected movement, but at 12.8%, to break that down into context, the market's expecting daily moves up or down in the gold price over the coming week of around about 0.8 of 1%. So again, that just sort of feeds into your risk management. If volatility is high, of course, then your position sizing needs to be a bit smaller. The amount of risk you take on to your stop probably needs a little bit wider. Okay, let's go into positioning as well. Just to give a sense here, I've looked at the Commitment of Traders report. We looked at managed money over gold and net long positions. You can see the net zero line at red is at zero, and net long positions have been coming down. They've certainly come off very stretched levels. We're looking at quite neutral levels in the gold market at the moment. So in terms of positioning, which of course plays really into our risk reward situation, if we know the market's very long of gold, and you don't get you might get a significant move higher in the US dollar or bond yields or so, then you could see that more exaggerated move to the downside. But we're at pretty neutral levels, relatively speaking, to where we've been. So again, all these factors really do matter. Let's have a look at the gold price. I've got the 4-hour chart here, and again, you've got this. Let's put it on the daily chart just to give us that little bit more oversight. Now we got the uptrend that's was broken on the 14th of June. We came right back down. You can see that on the 29th of June, we tried to make a new low. The buyers have stepped back in. We got a failed break there. Again, on the next day, on the 30th of June, we tried to step in. A bit of well, it's not quite a pin bar reversal, but you can see that there was a higher low coming through. Markets closed 50% of the previous day's bar, and then that was the stage then for a nice push up into the 38.2% retracement of that move. 1814 is your key level then on the resistance side. If we get a break of that, then I think this 200-day moving average comes into play. We probably may even get a move up into 1854. I think long positions in that look pretty good. We are holding the 5-day exponential moving average, and that's moving up. That's strong. Price is being contained into that, and until we can get a close below that 5-day exponential moving average, for me, I want to be neutral or long. But I am seeing signs that we may roll over. I'm seeing signs right here, right now, that short positions may be favoured. But it's difficult for me to take those positions until we do see a close below that 5-day exponential moving average. As you can see, we're holding there at the moment. But we've made a low, big rejection of that level here. We've made a lower high. Bulls have failed, the buyers are offside, and we're just starting to see a few sellers kick in. You can see the RSI has rolled over a little bit there. If you go into the four-hour chart, just have a look at that, how's that's reacted around that Fibonacci retracement level. Again, you can see it literally hitting to the T, and then bang, big, well, I can't say it's an outside reversal, but that looks like it could be a bit more vulnerable. If we have a look at what's been the strongest currency, it has been the Japanese yen. So if we are going to see gold prices rolling over, and that's going to be a function of perhaps of what's going in bond markets and risk appetite, then you've got this the market really capped at this 38.2% retracement. That might be one to look at. You can see the sellers are coming in at the moment, so one to watch out for in the short term. The Australian dollar, interesting one there. We've seen this really nice move up. We're up at the 200-day moving average at the moment, so that needs to hold. Let's see what happens there. If that can break through there, then being long gold in Aussie dollar terms may be the place to be. But for me, I think there's probably some downside risks in the short term. What I want to have a look at now is what a model that I like to use, and that is what we do against real rates. As you can see here, in the top pane, I've got the gold price, which I've inverted. So what you can see is at the back end is when the market's moving down. In fact, it's going up. But you're looking at the relationship relative to US Treasuries or inflation-adjusted US Treasuries. And what we can see is the white line has been moving down. So real rates have been moving down. That's traditionally been very good for the gold market. And that's what's caused, I think, this move up that we've been seeing in the gold price. But it's certainly lagged. And I think the market is a bit worried that we are going to see real rates turning higher in the short term. We've hit a bit of a floor and we're going to start moving higher. The fact that gold has moved a little bit higher but failed to really capture what we've been seeing in the real rates market, I think is because people are looking at next week's CPI and expecting a strong number there as well. If we have a look at the relationship that the US dollar holds with real rates, you can see it's been very strong, throughout 2020 into 21, but then that's decoupled a little bit as well. And the dollar's been strong at a time when real rates have been falling, and I think gold's also looked at that pretty closely. So that's a bit of a model at the moment. Gold should be stronger than where it is at the moment, but they're telling you a clear message that they believe that real rates are going to go higher, and that could continue to put strength into the US dollar ahead of that CPI print next week. So that's something I am watching very, very closely. So if we go back to our good friend gold in US dollar terms, if we do get a close below this 5-day exponential moving average, if we start making a move through 1792, that for me was going to be the trigger for short positions, potentially back for a move into 1765, and I think that will probably coincide with stronger real rates. So if we have a look at the market, at the moment, volatility has kicked down. That's got to be a big consideration for position sizing. We can see that real rates have been really supporting the gold market very closely because gold has no yield. So when effectively when the real inflation adjusted returns in the bond market becoming more negative, then gold becomes more attractive as a store of value, and that's where that white line kicks in. If that's going lower, gold becomes relatively more attractive, but it's held back by this US dollar strength that we've been seeing of late. So something to watch out for. My preference at the moment is to trade this from the short side, but I want to wait to see a little bit more flow coming in and see this trickle a little bit lower in the short term. So let's see what goes. And let's have a look at this next week as well. Thanks, guys.